The Echelon Radio Network presents the Tax Matters Radio Podcast, a conversation about money for everyone, with your host, Gary Weiss.
Welcome to the Echelon Tax Matters Specialty Group Podcast. I am your host, Gary Weiss. Why should you listen to this podcast? Because it's fun, informative, and easy to understand, and besides, it's free. It's a podcast written and developed for those of us impacted by the complex, lengthy, and confusing tax laws. Taxes of all kinds are part of our everyday life, and this podcast is a way to bring you relevant, easy to understand, and very relatable topics to help you make informed, sound financial decisions. If this is your first time hearing this podcast, my first question is why, and why haven't you listened to the other ones? So make up for it. I am a licensed CPA in California since 1996, and I practice in Woodland Hills with my partner, Quentin Staples. I also specialize in tax resolution services, which is back tax returns, unfiled this, unfiled that, and when you're hassled by the government. Hence my tagline, I fight the fascist state of California and the evil empire known as the IRS. Okay, enough of this intro stuff. No one cares anyway. Besides, my guest is giving me that look that says, come on, let's get started. So let's get started. Today's guest is Steve Weber of HW Premier Insurance Services. Steve, welcome to the podcast.
Thank you for having me.
Let's begin by you telling us a little bit about your background and how you got to where you are.
A background in insurance. I don't know if that's something to be that excited about, but I've been doing insurance for over a decade now. My partner's been doing it for 3 decades, and we specialize in using insurance to move assets. But we also work with the everyday person that needs insurance and wants a quality product, and we have their back more than just trying to find something that they need or don't need.
Yeah. Well, tell us a little bit about you as a man and how you got here and things you've done in the past that might be more exciting than insurance.
Well, I moved from Detroit back in the late 70s, moved out here and decided I wanted to get a career in entertainment. So I spent 30 years in entertainment. It's a long day. It's a long week. The hours are immense, but at the end of the day, you're happy with what you put out. But after 30 years of that, I figured it was time for a new career, new change, and met my partner and decided that I would get into the financial services business, and definitely wouldn't be working the 60, 70-hour weeks. So we specialize in insurance, mostly life and disability and long-term care. We don't do home and auto, and all my friends say, I got an auto policy, what can I do? And I said, listen, I'm the wrong guy for that. I barely know how to do my own policy.
Well, that's okay. At least you know what you do, and you probably do it really well. But as most people say, like when we talked earlier, as soon as you mentioned the word insurance, up go the blinders. People go, get cataracts immediately and don't see anything. But insurance can be a very important tool in the economic toolbox. So help us understand the role of insurance in the various parts of your, economic life.
Well, buying insurance, like I told you earlier, nobody wakes up in the morning saying, hey, I want to buy insurance, or I'm excited to buy insurance. They'd rather go to Best Buy and buy a big screen TV. There's just no way around it. But we all need insurance because what we're doing is we're transferring the risks from our personal lives to an insurance company, and they'll be there every step of the way to take over that risk. And when you look at the risk, if you were looking at, say, your home or auto insurance, the cost to buy insurance is much less than you having to carry that risk on yourselves of if you got in a car accident or injury, that you'd be bankrupt. So having insurance transfers that risk to the insurance company, and that's what their whole business is risk. And they're willing to take that risk because they have thousands of policies, and some will cash in and some won't cash in. In the life insurance business, what you're doing is you're protecting the downside of a catastrophic economic failure in your own home if something were to happen to you. So most people who are, if the breadwinner dies, they're 30 days away from being evicted from their apartment. So having some of that risk added to the insurance company and them taking it on for a low cost to someone to buy insurance, they can actually make sure that their families are protected, and the insurance company will step in and give them a lump sum of money to pay for rent and basic needs.
So help the listeners understand how insurance is an important tool in the estate planning process. You know, as people amass wealth, they want to pass that wealth on. That's one of the main reasons why they have it. And how does insurance help them do that? So in a way that they can maximize what they do pass on?
Well, everyone's got a different situation. And for the people that are high net worth and are in a estate tax situation where they've made a lot of money and they've been very successful, but at the time of death, the government says, hey, if you're over the exemption, and we can get into that, but you're going to have to pay estate taxes. Even though you paid taxes all the way, whether it's income or anything else regarding that, you're going to pay estate taxes. So using insurance will help you mitigate that by the insurance company picking up that tab if you buy enough of it.
Right. For those who don't understand or don't remember, what Steve was referring to is the estate tax limitation, which it currently is at $12.5 million per person. Now, this is going to sunset at the end of 2025, and there's going to be a lot of estate problems. But we're going to deal with that in a future podcast. But insurance is one way to help you pass on that wealth, and you need to work with a team when you have an estate. It should be an estate planning attorney, an accountant, an insurance person, so that you are able to maximize that which you pass on and pay as little taxes as possible. So let's keep going on. We discussed this earlier. One of the big things I have with my clients is I bought an apartment building. I'm going to stick it in an LLC because I'm going to protect it that way. So tell us, is that really a good way to protect it, and how would insurance come into play with such a purchase like that?
Well, putting in an LLC is, you're looking for transferring that risk from yourself to the LLC, but that's not necessarily the case always. And I think you need to talk to somebody who has knowledge in what that LLC will protect you from. But if you bought basically just an insurance policy, whether it's a liability policy or an umbrella policy, that's going to provide you much more protection, and it's at a low cost. There's the cost. You'd be surprised how inexpensive it is to buy a liability policy or an umbrella policy. It's probably less than what it's going to cost you to run that LLC by the time you pay the annual fee of $800 and file a tax return.
Great. So what is the difference between a regular policy and an umbrella policy? How does that work, and how do they work together?
Well, general liability policy, you're paying for basically if someone gets hurt on the property or someone's working on the property. Or an umbrella policy will just cover everything. That's why it's called an umbrella policy. So they kind of work the same, but the umbrella policy can be purchased for even less expensive than a general liability policy.
Yeah. To our listeners, a single member LLC, if in other words you own it, you have no other members. If you're married, you can say, well, my wife or my spouse is a partner. It doesn't work that way. A single member LLC is what's referred to as a disregarded entity and shows up on your Schedule E on your personal tax return. So in the event of a catastrophic loss, single-member LLCs are not really good at protecting you. The best way to do that is I tell all my clients who are in that situation, talk to an insurance person, get a regular general liability policy, and buy a large umbrella policy, and you'll spend less than that $800 a year, and you'll have way more protection. Now, if you happen to own, a large apartment building in Bakersfield, you need to cover yourself differently when the meth lab blows up. But that, again, is for another discussion. So another one of the questions that I get all the time, when one of my clients about insurance that they don't understand. What's the difference between an admitted carrier and a non-admitted carrier?
It's a little tricky. Admitted carriers are, I guess, state approved or government approved, and non-admitted. They could have some offshore parts to them, and I think the government looks at those as a little bit suspicious. So you always want to use an admitted carrier.
Give us an example of a non-admitted carrier that you use.
I don't specialize in using P&C type property and casualty type insurance. I do have a license for that, but I don't actually use any of those type of carriers because I don't sell any of those type of products. But even if I did, I would always use someone who's a credible company that's accredited here, that has a high rating, because I think we should all be looking at the risk ratings of these companies, because they are companies that are vulnerable to everything else that every other company is. They have employees, they have cash flow, they have their own insurance needs to cover them. And although an insurance company has never failed to pay out a claim, you still want to get a company that has good ratings and that is in good standing with the U.S. Government or your local insurance commissioner.
Yeah, you bring up a really interesting point that nobody ever thinks of. When I'm going to buy insurance, I watch my ads on TV. I'm going to buy, AAA or State Farm or Mercury, and they never look at beyond that picture. And you just mentioned risk ratings. Tell us a little bit about why the average person should look at that in an insurance company.
Well, I don't think to try and bring it down to the easiest to understand, if you're going to a restaurant and you look at the restaurant and there's a C on the door, which means that's the health department's ratings, you're probably not going to go to that restaurant. You're going to go to a different restaurant that has an A rating. Well, insurance companies, if they have a poor rating, there's a reason why they have a poor rating. They're just bad customer service. They haven't paid out the claims fast enough. And the ratings, and there's a few different types of ratings. There's the AM Best, there's Fitch, there's the Comdex. So there's a bunch of different ratings, but really the AM Best is probably your easiest to understand. It's a letter grade. And you want to do any company that is A+ down to A-, you should be fine. I'm sure there's reviews out there on every insurance company, and you want to do some homework to find out who's going to be there when you need them. Because if they're not going to be there when you need them, there's no sense buying it from them.
Okay, so it's time to renew my insurance. So I make an appointment. I go say, I'm going to go visit my insurance man or woman or whatever, the insurance person. And I get there. What kind of questions should I ask that most people don't ask?
I think when you go meet with any insurance agent, I think you have an idea of what you want, what you need, and what you can afford. And I think that's the first homework someone should do, is have an idea of what's affordable and what can help them sleep at night. Because an insurance agent, while they're there to help, they don't know what your situation is, and you don't want to be overinsured and cash poor. So if you have that homework that you've done going in, you'll be more educated when you start talking to somebody about what your needs are and what your needs, what you can afford.
Great. Okay. So should I ever say to my insurance person, I don't want to use that company? Or can you tell me why I should use that company as opposed to this company? Should I be asking those questions, or should I just rely upon the insurance agent to tell me that, or just assume they know what they're doing?
Well, there's two different types of insurance agents. There's what's called captive, which is an insurance agent that can only sell the company that they're working for. And then there's non-captives that are allowed to sell, which is more like an insurance broker that can give you all different companies to look at. An insurance agent that's a non-captive should give you 5 or 6 choices of what they feel are the best. And then you can do your own homework and see which company makes you feel better. I remember when MetLife used to have the Snoopy character, everybody wanted the Snoopy character. And MetLife, as you can see today, they're not even around anymore, and there's no Snoopy, and there's a reason for that. because they really weren't taking care of their clients. But they had that Snoopy, and that's what people were like, oh, let's do the Snoopy. Or people rush to Aflac because they like the duck. And I don't think that's a reason to buy from any of these companies.
All right, so tell our listeners, what makes you different in the way you treat your customers, and how do you take care of them?
Well, since we are a boutique high-end insurance broker, our clients are usually the CPAs and the attorneys that work with their clients. And we wouldn't have those relationships unless we were giving the proper advice, the correct numbers, and doing our due diligence and knowing what we have to say to the CPA or the attorney, that it's really the right thing to look at. And I think that's where, when it comes down to someone who just is looking for 10-year term insurance or long-term care or disability, we use that same principle, and it's not always about what we need, it's about what's best for the client.
Absolutely. So let's just change directions here for a moment. I know you don't do the property and casualty, but a lot of listeners are curious now. We had that huge train derailment, right, where there was noxious chemicals spilled, and then we had all the fires in California, and where PG&E were supposedly responsible. How do insurance companies deal with these gargantuan losses? I mean, these are not, $1 million loss. These could run into the billions. How do they deal with these kind of losses and still stay in business?
Well, that's what I think the problem is here in California, especially after the fires. They have to pay out because they're mandated by the state to pay these claims out. But you're finding that what's happening is they've had such big losses that they're not willing to renew, and they're not willing to write any new business in these areas. And we're running low on carriers that are willing to work in these so-called fire areas or flood areas. Earthquake insurance is still not as hard to get because we haven't had a big earthquake in a while. But to buy home insurance in a fire area is very difficult these days, and it's gotten a lot more expensive. And a lot of people are on what's called the California Fair Plan, which is a state product. Definitely not the quality that you'd want, but some people are just forced to do that because they have no other choices.
Right. Well, when you get a mortgage, the mortgage company is requiring you to have fire insurance. So if a regular carrier won't insure you, that is your last hope, I assume.
That is the last hope.
So what is the range? I'm hearing all sorts of horror stories from people who had to renew their fire insurance. It went from $3,000 to $30,000. I mean, is this realistic? Is this true?
It's what's happening in the marketplace, but people can't afford that, so that's why they end up in the Fair Plan. In the Fair Plan, you're going to need another company as your comprehensive, because the Fair Plan really just covers you for fire. And you need a total loss, really, which is unfortunate because they just don't look at things the way the other insurance carriers do.
Yeah. So one of the things I worked with years ago was a company that insures insurance companies, reinsurers. Can you tell us a little bit how that works?
Well, insurance companies need insurance just as well. They're willing to take on a certain amount of risk. Some of the risks may be over their limits, so they need another partner to come in. That's called a reinsurer. It's across the board in all the different types of products that are out there. There's reinsurers out there, and they're there to back up the insurance company and take on some of that risk from the insurance company.
So I'm curious then, do the reinsurers have their own reinsurers? I mean, is this like one of those things that goes on and on and on? And
that's a good question. I don't know if I've ever heard that asked, but they're pretty big companies. They look at if the insurance company that they are behind is doing their due diligence, they're willing to step in.
Okay. Let's again, we're going to change direction slightly. Let's talk about term and whole life. This is something that to a lot of people is very confusing. They go, well, what's the difference? And then there's universal whole life. And insurance companies love to put these fancy terms in front of insurance. And as far as I'm concerned, it's just to confuse people. So can you sort of break it down in simple? What's the difference? Because those seem to be the two general categories, and there seems to be subcategories under there, which is where everybody goes and gets cataracts instantly when you talk about insurance.
Right. Yes, the insurance companies, they're always looking for some new angle to attract policy owners. There's term life insurance, which is the cheapest, and that's what is mostly sold as a basic protection. On term life insurance, about 4% is pretty much whatever gets paid out, so that's very little, so that's why the cost can be so low. But these policies are really only good for the term that you pick, and that could be 10 years, 15, 20. They've even just added a 40-year term, which I think is great for young people, that they can buy a policy that's good for 40 years, the price will never change, and they can buy quite a bit of it and not always have to worry about renewing or having an insurance person come and going, hey, I got something better for you. And if you look at a whole life policy, or what you mentioned, a index UL, those are cash value accumulation policies, and there's less death benefit in those. Those are the type of policies that you put some money away and you'll build cash value. You can use that for whatever your needs are. You can pull it out tax-free, and it is an expensive way to buy typical life insurance, but it's a great way to accumulate cash.
So when do you buy which, either one, the term or the whole life? When is it most applicable for either one?
I think it's, if you're, say, 35, 40 years old and you have a job and you have a home and you have a family, you're definitely going to need term insurance. And you're going to need to buy a fair amount to cover that, but the cost is pretty low. But if you can buy some whole life or index universal life at the same time and start building a bucket of cash, and if it's affordable, then I would say do both. If you don't have a employer that has a 401k plan and is contributing, you can create your own 401k plan in a universal life policy, like an index UL, or in a whole life policy. Yeah. And you'll build a bucket of cash just like you would in a 401k. The difference is that a 401k or a qualified plan like that, you're going to be forced to take that money out. Right now it's at age 75, but you'll pay taxes. If you have it in an insurance policy, as long as you keep that insurance policy going, you can pull it out tax-free.
Yeah, this is where we start to lose listeners, and they're going, what did he say? I have no clue, but that's okay.
It's the insurance black hole, we call it.
Yeah, at the end, Steve's going to give you a whole bunch of contact information, and I encourage you to talk to Steve or at least find out what's going on. So let me ask this question about age. So people seem to buy life insurance at all ages. You see these things for ARP. To buy this, the guy's 900 years old, but you can still buy term life insurance. How does that work? I mean, is it obviously the older you are, the more expensive it's going to be. But if you're 70 and you don't have any insurance, should you buy insurance?
Well, at age 70, the cost is going to be pretty expensive. I mean, it's going to be way more than probably most people are willing to pay, and that's why they don't have insurance at that age. I think the sooner the better you can buy permanent insurance at 35, 40, 50 years old, and you can afford it and have it to go to your age 100, you won't have to worry about that at age 70. But it's expensive, and I think you have to find a balance of what you can use for term for the short period while you're making money and you have a family. So when you're at 70, you have a policy that will last you for as long as you need it.
All right. So depending on your economic situation, would you recommend a healthy male, 70 years old, and there's lots of them these days, to get term insurance?
No. There's no reason to buy term insurance at age 70 because there's no conversion. We can get into conversion, but we're going to lose people on that one too.
Oh, yeah. Besides, it has a religious overtone, and I don't want to go there.
At age 70, to get a term policy, you're going to get. They could cost as much as the benefit you're going to get back. It's just not the right time to buy it. Term is usually for someone who's 50 and under.
So should a 70-year-old healthy male have any kind of insurance?
At that age, It depends on what your needs are. If you have estate tax issues and you know that you're going to have estate tax issues, I think that's the time definitely to buy some insurance. You might want to look at what's called a survivorship if you're married to cut the costs down. That's usually where we see it at age 70. It's someone who has an estate tax issue. And like you said, today the exemption is pretty high, but back when the end of 25 comes, that exemption is expected to go pretty far down. So there could be a lot more people in the estate tax game.
Yes, what I've heard is $3.5 million to $5 million, depending on, those lovely people in Congress,
Right.
if they can agree on anything. I don't think they can even agree on lunchtime.
No, that's true.
In that place.
But
Okay.
but in Southern California, if it got down to $3.5 million or even $5, a lot more people are going to be in that estate tax issue.
Oh, yeah, absolutely. Given property values and how things have gone up in the last couple of years, it's going to be a big deal. So another type of insurance is disability insurance. And when you talk to people or you hear insurance people, they'll say, well, there's a short-term policy and there's a long-term policy and there's all sorts of disability policies. How do those work?
Yeah, disability, for the most part, disability is usually for professionals that if something were to happen and they couldn't work and use their hands or something like that, that's where we see most of that. A lot of entertainment people get disability insurance. But for the everyday person, it's pretty costly, and usually they only pay out to age 67. Some are even less. They used to have these policies where they pay forever, and all of a sudden you saw all these people who had policies were going on disability claim, and you're like, really? You seem fine. But they had these policies that they knew they would get paid out forever. So that changed that game quite a bit. And disability insurance is maybe not for everybody. There's short-term, like an Aflac type policy, and there's long-term disabilities that are Lloyd's of London or even the big carriers like New York Life, Mass Mutual. You want to get a quality company because the payouts on those are going to be for a long time if you go into a disability situation.
Yeah, I believe Lloyd's of London is one of those non-admitted carriers. But people use them for everything because they're sort of big, I think. I'm not sure about it.
Yeah, Lloyd's of London is not admitted, and if you're a entertainment professional, that is the only company that will write it.
Interesting. All right. So let's go back and change directions again, which I love to do. Let's talk a little bit about the origins of insurance. Do you know much about where did insurance start? Why did people insure stuff? And, insurance companies, they got these big, huge buildings. They have trillions of dollars in assets or whatever it is they have. So where did it start?
These insurance companies have been around, for the most part, hundreds of years. I think Mass Mutual is 150. New York Life is over 150. I mean, they've been around for a long time. Even the other carriers that are out there that do homes and autos, I think someone got an idea that said, hey, if I can get 100 people to pay me $100 a year back in the 1800s, that I could, if out of those 100 people, I might get 2 or 3 that might have a claim, and I can use that money to pay it out, and I'll still be able to make money. And then when I have that money in my bank, I can start loaning that out to other people that need to build buildings or build roads. And they're the big part of the finance community is the insurance carriers because they have so much money on hand. Their whole business is taking money in, finding a way to use that money and grow it in their own general account. And then when the time comes to pay a claim, they have plenty of money to pay that claim out. Now, the biggest thing with insurance companies, and most people will know that insurance companies will find any way not to make a claim or pay a claim. So that's where I think they get the bad black mark on their name, insurance.
Well, that seems to be driving the personal insurance, PI attorneys, all around seem to be, we'll get you more for your claim if you were in an accident. I know if you scraped your bumper, we'll get you $1 million type thing. So people understand. But let me ask you this question. So I have insurance. I have a problem with my insurance company. Can I come to you and say, hey, I don't think I'm being treated correctly. I'm not sure where to go. Can they come to you and get help?
We're happy to review any policy. We have plenty of policies right now where an insurance agent came to someone and said, here, borrow a lot of money, you'll get a big policy, and that policy will build cash and it'll pay off, and then you'll be able to pay off the loan that you took. Well, that's all great if the moon and the stars line up, but that doesn't seem to always work. And right now, with the interest rates going up and the crediting from the insurance company that they're going to give you back, seems to be switching more towards these type of policies not working. So we do a lot of that work. We look at the policies and try and help the clients out to figure what's best for them and when to pull the trigger to either cut loose with this policy or find a way to refinance it maybe. But even the regular term policy, if someone has a policy that the term's coming up, or they'll wait till the end of the term, and then when they find out what that term cost is to go forward, it's staggering because it turns into what's called an annual renewable term. So they can just jack up the price every year.
Oh, that's interesting. So can insurance companies do whatever they want, or who monitors insurance companies?
Well, every state has a state commissioner. Every policy, the product has to go through the approval process. A term policy is guaranteed for that term, never to change the cost, and I think that's what we all look for. But you want to not have to get to the end. You want to review these. These are a financial instrument, just like anything else. If you're reviewing your investments and you're reviewing your mortgage, I think insurance is another financial tool that needs to be looked at more periodically than people do.
Okay, so let's circle back because we're almost at that time. But let's circle back to your 30 years of entertainment experience. So how are you merging those two, the insurance and your experience and your contacts in the entertainment business?
Yeah, so part of the reason why I was able to make the transition is because of my relationships with entertainment professionals and the business managers and the CPAs that manage these celebrities and people behind the camera, people that work in front of the camera, and some of the companies. So we try and that's how we first started out, was specializing with entertainment professionals. And as time went on, because the entertainment professionals have estate tax needs, we've moved into just the everyday common person that's made quite a bit of money that needs help.
Great. All right, so we're getting towards that time. So tell the listeners, how do they get a hold of you? And what if they do, how do they get a hold of you?
Sure. I mean, I'm happy to talk to anybody and review. There's no cost for it. It's Steve Weber at HW Premier Insurance. You can email me. My contact information's there. My cell phone's on there. I'm happy to take a phone call anytime and see if we can help you out.
Great. What's your phone number?
818-222-2300 for the office. That's pretty easy.
Yeah, that one's pretty easy.
222-2300.
All right, great. Well then, intrepid listeners, this is all the time we have for today. I would like to thank my guest, Steve Weber. Please look forward to future podcasts when we do this incredibly interesting stuff, and I know you're all sitting on the edge of your seats. So look forward to those right here, same bat time, same bat channel. I guarantee you will be entertained and enlightened at the same time. I'm your host, Gary Weiss. I look forward to spending time with you on our next podcast. Y'all come back now. You hear?
Tax Matters Radio Podcast.
Presented by the Echelon Radio Network.
And Echelon Business Development.
More than just networking.
Way more.